All right, let's talk about something that sounds complicated but really isn't. The VA funding fee. You hear those words, your brain might just tune out. It sounds like financial jargon meant to confuse you. But I promise, by the time we're done, you'll understand it completely. Think of this as your personal cheat sheet. We're going to break down what this fee is, why it exists, how it affects your wallet. No confusing banker speak, just straight talk. Getting a home loan is a big deal. You deserve to know where your money is going. The VA funding fee is a one-time cost paid to the Department of Veterans Affairs. You'll encounter it with a VA loan. Buy a home, build a home, improve a home. It's not a hidden gotcha from your lender. It's an official part of the VA loan program. Good news, you don't always pay it at closing. Most people roll it into their loan amount. It's a straightforward part of a benefit you've earned. The main purpose here is clarity. So many miss out because they get bogged down in details. They hear fee and assume expensive. See the whole picture, and you'll know why this fee helps make the loan powerful. It unlocks perks. No down payment, no monthly mortgage insurance. It's a small price for a massive advantage. Let's set the stage before the numbers. VA loans are one of the best tools for military members and veterans. They've helped millions become homeowners. The funding fee is one piece of that puzzle. Understand it. Use your benefit with confidence. You'll know the rules, you'll know the costs, you'll be in the driver's seat. Let's get you there. We'll make you an expert on the VA funding fee in the next few minutes. So, why does the VA funding fee even exist? It's a fair question. The answer is simple. It helps keep the VA loan program running for generations of veterans to come. Think of it as a user fee that keeps the system healthy. The money collected from this fee goes directly back to the VA. It acts as a kind of insurance pool. If a VA loan were to default, this fund helps cover the loss for the lender. This guarantee is what makes lenders so willing to offer such fantastic terms to our military members. Without this fee, the program would likely rely on taxpayer dollars to cover those potential losses. By having borrowers contribute, the program becomes self-sustaining. This is a huge deal. It protects the program from political budget cuts and ensures its long-term stability. The fee you pay helps guarantee the veteran who comes after you will have the same incredible opportunity to buy a home with no down payment and no monthly private mortgage insurance, PMI. It's a way for veterans to help other veterans secure their piece of the American dream. On a conventional loan, if you don't put 20% down, you're stuck paying PMI every single month. That could be hundreds of dollars added to your mortgage payment for years. The VA loan lets you skip that entirely. The one-time funding fee replaces years of expensive monthly insurance payments. Not all funding fees are created equal. The amount you pay depends on a few key factors. First, is it your first time using a VA loan? Second, how much of a down payment will you make? The VA wants to encourage homeownership, so first-timers get a break. It's like a welcome bonus for using the benefit you've earned. First time, zero down. Funding fee roughly 2.15% as of late 2025. First time use, 2.15%. Subsequent use, 3.3%. Example, $300,000 loan times 2.15% equals $6,450. You can pay this at closing, or most people roll it into the loan, making the new loan total $306,450. Now, subsequent use with zero down, the fee is about 3.3%. On a $300,000 loan that equals $9,900. If you put down between 5% and 9.9%, the first-time fee drops to 1.5%. Put down 10% or more, and it drops to 1.25%. The same logic applies to subsequent users. Their fees also decrease with a down payment. You can go with the incredible zero down benefit, or lower your one-time fee and total loan amount by contributing some cash up front. Percentages can and do change based on legislation, so always check current rates before you buy. But the principle stays the same. First-time use is cheaper. Subsequent use is a bit more expensive. And making a down payment will save you money on the fee no matter which category you fall into. Always run the numbers with your lender to see what makes the most sense for you. When you do the math, paying the funding fee is often a much better deal in the long run. It's a small, one-time hurdle for a long-term financial win. So, don't think of the funding fee as a penalty. Think of it as your contribution to the club. Section 4. The Golden Ticket. Who gets to skip the funding fee? Now for the best news of all. Some veterans don't have to pay the VA funding fee at all. That's right. For certain individuals, it's completely waived. This is a huge financial benefit. It can save you thousands, even tens of thousands of dollars on your home purchase. Primary group: veterans receiving compensation for a service-connected disability. If you get monthly VA disability payments, you are exempt. It's that simple. Exemption also extends to a few other groups: entitled to disability compensation but getting retirement pay instead, exempt; entitled to disability compensation but getting active duty pay instead, exempt. The key is entitlement to the disability pay. Surviving spouses of veterans who died in service, typically exempt. Surviving spouses receiving dependency and indemnity compensation, DIC, typically exempt when using the VA loan. This is a critical protection for Gold Star families. What if your disability claim is pending at closing? If the claim was in process at closing and later approved with an effective date before closing, you can get a refund of the funding fee. This provision surprises many people. You must be proactive and apply for the refund. The VA has a process to return that money. Your lender will help get a certificate of eligibility from the VA. That document will state whether you are exempt. If the certificate says exempt, you're golden. You won't pay a dime for the fee. If your COE doesn't reflect an exemption you believe you qualify for, work with the VA to update it. This exemption is one of the most valuable parts of the VA loan program. Verify your status. Section 5. Refinancing rules. A different set of numbers. The VA funding fee doesn't just apply to home purchases, it also comes into play when you refinance a mortgage. However, the rules and rates are a little different depending on the type of refinance you are doing. The VA has two main types of refinance loans, and each has its own funding fee structure. It's important to know which one you're using, because it can have a big impact on your costs. The first, and most common, is the Interest Rate Reduction Refinance Loan, or IRRRL. An IRRRL, sometimes called a VA Streamline, is designed to do one thing: lower your interest rate and your monthly payment. Because this type of loan helps a veteran's financial situation and reduces the risk of default, the VA encourages it with a very low funding fee. The fee for an IRRL is a flat 0.5% of the loan amount for all borrowers, regardless of whether it's your first or subsequent use. That's significantly lower than the purchase loan fees. On a $300,000 refinance, that's just a $1,500 fee. It makes refinancing to a better rate extremely accessible. The second type of refinance is the VA cash-out refinance. This loan is different. It allows you to tap into your home's equity and take cash out, essentially borrowing against the value of your home. You can use this money for anything you want: debt consolidation, home improvements, college tuition, you name it. Because you are taking on more debt and increasing the loan amount, the VA views this as higher risk. Therefore, the funding fees for a cash-out refinance are the same as they are for a home purchase loan: 2.15% for first-time use, 3.3% for subsequent use, assuming zero additional equity. And of course, the best rule of all still applies here. If you are exempt from the funding fee due to a service-connected disability, you are also exempt when you refinance. It doesn't matter if you are doing an IRRRL or a cash-out refinance. Your exemption waives the fee completely. This can make refinancing an incredibly powerful tool for disabled veterans who want to lower their rate or access their home's equity without incurring that extra cost. Always check with your lender to confirm the exact fee for your specific refinance scenario. Section 6. The Big Picture, where your money goes and what it means for you. So, let's bring it all home. The VA funding fee might sound like just another expense, but it's the bedrock of the entire VA loan program. That money you pay goes into a fund that insures lenders. And that's why you get no down payment, no monthly mortgage insurance, and competitive interest rates. It's a system of veterans helping veterans. Bottom line, it's a one-time charge. Rate changes with down payment and first-time use. Exemptions exist, and you can pay it or roll it in. If you're a veteran on active duty or a qualifying surviving spouse, the VA loan is one of the most powerful benefits you've earned. Now you know exactly how the VA funding fee works and whether you actually have to pay it. Use it with confidence.